So let's just get into the top three things. Number one this morning is foreign currency markets. I'm going to summarize all the big ones. And then Europe, number two, and number three, the 10-year bond yield, which I'm getting a ton of questions about. So first on foreign currencies. Foreign currencies, interesting, not surprising move on Friday. So again, I was wrong on the jobs report. The market obviously looked at that and said, why don't we take interest rates up and take the dollar up for a day? So again, for a day is not a trend. It's barely even a trade. But at the end of the day, it was a shocking move that was faded by international currency markets again this morning. The yen showed no follow through to the downside. Neither did the euro. Both of those are up this morning. And now what I'm seeing, which is very interesting in my model, is a tightening risk range across all three major currencies, the euro, the yen, and the dollar, which is a very interesting setup in lieu of what's been nothing short of an epic move to the upside and a very volatile set of foreign currency impacts since really this started at the end of June of last year. So something to think about there. Point number two is, of course, Europe. And Europe is just getting buckled this morning because, of course, Greece is still Greece. So I don't know why this continues to be the byline or the storyline. But again, it is what people, I guess, worry about. What I'd be more concerned about in Europe is that people only own the European equity markets for central planning. Now, again, since the central planning, you can see all these charts. They put in basically their highs, and they've not been able to blow through or get above those Viagra-oriented highs. And again, this morning you have much more violent moves to the downside in markets like Spain, Italy, and Germany than we've seen on a one-day basis. Now, whether or not they hold and whether or not there's another rumor for another European bailout by today's close or tomorrow is entirely a different storyline, so we'll have to stay tuned for that. Finally, 10-year bond yield ramps straight to 195, 196. I get a ton of questions because people are like, well, the top end of your risk range was, you know what Mr. Market thinks about my risk range on standard deviation moves of 4 to 5 times? I don't care about your risk range is what he says. So again, don't get so caught up in this thing. At the end of the day, it's not a science, and it's specifically going to nail every single day top and bottom end of the risk range. I think our risk ranges are better than the alternative, which are other people's risk ranges. But again, look at the risk range for what it is. It's dynamically changing. It's constantly in flux and flummoxing relative to what this job market really is. If you look at the jobs market on jobless claims rate of change, ADP rate of change, anything that's a component of an employment index, whether it be ISM, they were all weakening, and bang, you get a very strong payroll number in between all that. So again, all that does to me is gives me a new risk range on the 10-year bond yield with the low end of 164, the high end of 195. Please, I hope, please, you did not sell bonds at 195 on the 10-year. Again, we signaled to buy them there because that is indeed what we do. And those are your top three things.